This is TreppWire Week in Review for week ending November 25th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, earnings season winds down with more retailers showing better than expected results. And a shortened trading week due to the holiday means more focus on what the Fed is signaling for December. Manus, it was a lighter trading day, but stocks rallied. Is that just a holiday bump?
I would say so. The pilgrimage began Friday. You started to see real distance between one email and the next. The phones weren't ringing much, fewer and fewer texts. It was evidence that traders and money managers had already, jumped into their Volvos and were heading to the mountains or the family locations or whatever that might be, and things were slowing down. So that's the way it goes every year. So it's hard to put a lot of stock into 400-point rally in the Dow on the Tuesday before Thanksgiving. And the same may be true tomorrow. We have the Fed minutes coming out, and how many traders are actually at their desk to parse through those and move the market, or money managers, remains to be seen. I think it'll be very few. So it may wait until next week that we see a real bona fide reaction to what's ever said in those minutes. It does feel, however, like there's even more yin and yang right now in the markets than even before. I think that the market is eager to rally, and there are a lot of people out there that believe that peak inflation and a Fed pivot is imminent. And then you have an equally dug in constituent, which is saying, no way, the Fed is going to stay aggressive. And that really comes in some cases from the Fed themselves telling us that, and that there's a long way to go before we're going to see any kind of Fed pivot. And I think it can go either way. But right now, the market does not have a real clear direction, and it may be several weeks before we really get one and we start seeing more CPI data, PPI data, and interest rate moves.
Yeah, it's interesting, man. It's on the Fed side of it, because as we enter the holiday season, we have Thanksgiving this week. But if you look at number of days between now and the first of the year, there's not that many working days. There's not going to be that many trading days. There's a lot of information that's still a little uncertain. So I think we'll see, kind of the tone in December. The Fed, there were several comments coming out this week. Cleveland Fed President Loretta Mester said the recent data from her perspective is promising, and that she'd support reduced interest rate hikes going forward. Federal Reserve Bank of Atlanta President Raphael Bostic said that he was ready to move away from larger rate increases. So, we've had some sentiment saying that maybe they've done enough to come down to a 50 basis point or 25 basis point rate hike in December, but we'll see how that actually plays out. CME Group does a study. They're pegging it at about a 75% chance right now that the Fed lifts the federal funds rate by 0.5 percentage point rather than 3/4 heading into this next month's update. So, we'll see how that actually plays out. A couple of other segments we'll hit on today: housing market and retail earnings. So in the housing market, we're a little premature. New home sales data from October is supposed to be announced tomorrow. We're recording this on Tuesday, but they're projected to drop from just over 600,000 to about 570,000. Just shy of a 5.5% decrease. And then there was a story today, Redfin put out some stuff today that said the investors buying homes tumbled 30% in the third quarter. So I remember us going through some of the John Burns consulting data at the first half of 22, where 1 in 3 single family homes was actually being purchased by an investor. Seen a significant drop off there. Says they bought about 66,000 homes in 40 markets tracked by Redfin. And that was compared to about 94,000 homes during the same quarter a year ago. So pretty significant pullback there. Kind of an interesting story, though, Amanda. You and I can probably do a little back and forth on this. Home equity line of credit seems to be making a comeback. So it looks like HELOC balances are now at about $322 billion, which is up $5 billion in the last 6 months. So what's interesting here is as 30-year fixed rate mortgage pricing and interest rates are significantly higher now than they were over the last several years, people that are locked into those really low fixed rates don't want to move and have to buy a property in the new interest rate environment. So they're maybe tapping into some of that equity. And, I think this maybe bodes well for some of the Home Depots and Lowe's and other retailers that we talked about last week that were struggling a little bit. because people are actually able to tap into some of that equity, rehab or refurbish some of their existing property?
Well, I think it's a great question to ask. I think we don't really know. It's been a long time since we've seen this kind of environment of just how resilient the consumer will be. And I think it's a great thing to ponder. And I'm sure there's a lot of research out there from the various banks that talk to this. But I think we're really in uncharted waters. When you think about the potential for job losses, right? The job losses have been announced, but they haven't really kicked in yet. But they are serious, right? We saw today, HP, I think it was 4,000 to 6,000 jobs. We've seen a lot of tech jobs announced as being lost. When those announcements start to come, I don't think they just impact the people that could be laid off. I think they're impacting the whole world, or they do impact the whole world. People start to think maybe now is not the time to buy the super deluxe SUV with all the bells and whistles for $75,000. Maybe it's time to kind of just tap the brakes and see what happens going forward. And when you pair that with higher interest rates and a lot of narrative out there that we're going to see a recession in 2023, you just wonder how resilient the consumer will be, right? Their balance sheets may be flush. They may still be reaping the benefits or, of having these payouts in 2020 and 2021 of having higher wages over the last couple of years. But how skittish they get because of what's happening around them, I think is a big question going into 2023. And we won't know how that plays out, I don't think, for a couple of months.
Manus, you bring up a good point. You talk about the resilience of the consumer. We saw a number of data points come out this week that talked about that point and how that was still relatively healthy, but potentially signs of trouble. We saw that the number of the savings rate has stayed one of the lowest percentages that we've seen for some time. It's 4% of disposable income. And if you recall, during the height of the pandemic, it was 16%. So that was in 2020. So that number obviously is a sign of the health of the consumer. The other data point, the Federal Reserve Bank of New York said credit card balances have increased 15% year over year in the third quarter, the largest increase in over 2 decades. So a couple signs that aren't potentially catastrophe yet, but they do show that potentially the consumer is stressed.
Well, it's like Bob Seger used to sing, we're searching for mysteries without any clues. This lower savings rate and the higher credit card usage, is that a function of inflation and people having to dig deeper to pay for food and housing and other things? Or is it a function of we came out of this pandemic and we're going to party like it's the roaring 20s, right? We were locked down for 2 years. We haven't had a vacation. And, we're going to max out the credit card. We're going to Dollywood and calamari for everybody. I don't know. It's hard to say. With a 3.5% unemployment rate and with people having more disposable income, at least on the revenue side, certainly not on the expense side, my guess is that people felt flush. And some of that is people kind of taking the reins off and spending some money where they couldn't in the last couple of years. But I'm a tourist when it comes to consumer behavior, and we'd love to hear some of your remarks from those listeners out there as to what you feel about this.
And we saw a number of retailers announce earnings. And again, it was more positive than negative news. And maybe it was just because we were expecting it to be a little gloomy.
Well, I think the whole earnings season, even though earnings were not up enormously quarter over quarter, I think any beat was considered a good beat in this quarter. I think that going into it, the tone was incredibly negative. I think people thought we were going to see dismal earnings. And what we saw was generally decent earnings, right? It wasn't blow the roof off expectations, but it was acceptable other than in the tech space. And I think leading the way in those beats were some of these retailers. And, that speaks to, I think, a resilient consumer, right? It underscores the fact that people are still spending, or they were at least last quarter.
Yeah, so if we actually look at a couple of these companies, Best Buy rallied 7% pre-market after third quarter results beat analyst estimates. They registered a smaller than expected decline in comparable store sales. We talked last week about Target, Kohl's, and a couple of the other larger retailers. And inventory was a major theme for them, where they had mismanaged and not been able to keep that under control. It looks like Best Buy actually did a pretty good job there. It said they managed to work its inventory down by 14% year over year, but they did warn, saying they're seeing more promotional pressure than last year. Kind of a theme coming from the CEO on the call was that it's just an uneven market depending on, how you came out of the pandemic, and it's unsettled. So I think while they're managing day to day, trying to keep inventory levels at a manageable level, they're not really sure what the market is. I think your lead into today's pod, man, has kind of hit it on the head. Dick's Sporting Goods reported better than expected third quarter profit and revenue, unexpected increase in comparable store sales. Urban Outfitters also reported quarterly earnings that were slightly below estimates, but they beat revenue street forecast. Company said it was encouraged by trends seen so far during the holiday quarter. They gained 2.2% in pre-market action. American Eagle was up Tuesday after the clothing company, had a really strong third quarter beat, and said it also mentioned that it reduced inventory levels. The quote there was, "Bold actions to rationalize inventory and reduce expenses are paying off. Our inventory is in good shape, up 8% to last year, with progress continuing into the fourth quarter." So I think that's something that's top of mind for all of these retailers. And I think, you and Martha talked a little bit about some of the consumer challenges or maybe some of the unknowns there. Some of the analysts on the street were saying there's right now what they're calling a retail bifurcation, in which shoppers gravitate to stores, on one end of the spectrum. So what they're calling extreme ends of the price scale. So in this instance, it would benefit some of the discount brands, and it would likewise benefit luxury or specialty brands, but kind of leaves those in the middle behind. And I think Target and Kohl's may be indicative of that from what we talked about last week, where they're kind of that middle of the road brand from an apparel perspective, et cetera. And both of them had really dismal reporting earnings in the last quarter.
In terms of your bifurcation, one thing that caught my eye that was really surprising was Dollar Tree today, which is obviously at one side of that barbell, the extreme discount end of the consumer segment. And they came out with guidance today that was disappointing. Their shares were selling off today. You would have thought in this market, Dollar Tree would be really outperforming, not the case today. And then as a parenthetical, this came out after our podcast last week, so we didn't mention it. Sally Beauty, which has about 3,700 stores worldwide, most in the US, they announced that they were going to close 350 stores in the near term. So that's about 10% of their footprint. And we haven't seen this in a long time. We haven't seen a company come out and say, other than pharmacies, which have been big store closures, we haven't seen a retailer with that kind of number in a long time. So something to keep an eye on for retail operators.
So one more story, we'll kind of finish up this segment. Friday, Carvana laid off about 1,500 people. That was the second round of layoffs in 6 months. Their bonds are trading at distressed levels. Their CFO, effectively said they're in a cash crunch. They could potentially borrow against the real estate, which includes sites that they actually purchased this year. They raised about $500 million from selling some sites where it inspects cars. And then they did, what we call a sale leaseback, where they leased those sites back for 20 to 25 year terms. That may be a short-term solution for them, but even with that, it adds an additional expense to the balance sheet for them. And if you look at some of the marketed properties that they have online, there's a 12-story flagship vending machine, which we've talked about a little bit on the pod before, in Atlanta, that Carvana sold and leased back in December. And that was actually relisted again this summer. It's still on the market, and the asking price has been lowered. So, not shocking. There's not a huge appeal for someone buying something where they're not sure if the current tenant that's leased it for 20 years is going to be solvent. And the real estate that supports that is a vending machine. So, I think we'll see some more headlines around this just because it's an interesting story. The reality of 2 rounds of layoffs in 6 months doesn't bode well for the company at this point.
How many quarters do you have to put into that vending machine before you get a car? I mean, it's got to be an extraordinary number. And if it doesn't come out, like how many men would it take to shake the vending machine?
Yeah, I always envision like putting one of those big like golf checks that you win at the end of a tournament. Like you feed that into the dollar slot, and it's like reading these huge checks for $20,000 or $40,000.
He's spitting it out like, the vending machine over and over and over again.
Yeah.
So let's start digging into some of the property sectors. We're going to start with one that is in the other category. And the reason it's in the other categories, it's a story that has a number of different property types that are on the ground lease. So Lonnie, you're going to have to break down this convoluted story so that it's intelligible.
Yeah, so now that you've taken my word convoluted, I'm going to be at a loss in trying to describe this, but we'll go ahead and jump in and see what I can do here. So what we're talking about is the property at 20 Times Square. The collateral for this deal is actually the 99-year ground lease. And then on top of the ground lease, so the leasehold improvements were 3 different revenue streams. There's a hotel, 4 floors of retail space, and then the Times Square electronic billboards that generate revenue. And this deal was originated in 2018, so it was pre-pandemic. And going into that loan, it actually looked pretty strong on paper. It had the NFL as one of the flagship retail tenants. They were actually leasing the retail space. They were supposed to generate about $8 million a year in rent. And that was based off of a percentage lease. So they were actually paying rent based off of store sales, which they've since vacated, which creates complications for them. Then the hotel that was also on the property, or still is on the property, ran into some troubles. Obviously, COVID didn't help that. And it's actually been foreclosed upon by the ground lease holder. And in addition to that, the hotel has about $26 million worth of outstanding construction liens. And that's according to this month's servicer commentary. So when Martha says convoluted, she's accurately describing this. And then to make it even worse, there's actually debt on the ground lease that's not securitized. So for CMBS folks, this deal is spread across 4 different deals. The largest exposure is a $750 million piece of the TSQ 2018-20TS deal, which is a subordinated piece of the debt package. There's some smaller pieces spread across 3 other deals. So it's really interesting to just see this play out. I mean, we've talked a little bit on the podcast around ground leases. We put out some research. I think Max Nelson wrote a research piece on ground leases not too long ago. And in New York, it's not uncommon to see properties on a ground lease. What is a little uncommon is seeing each of them with individual revenue components. So in this case, distinct retail, hotel, and signage, and then have all 3 of those go bad, over a short period of time is a little unprecedented. So just to add a little context here on the rental side for the signage, the signage lease amounts for this place is really, really incredible. So let me find that here. So it looks like for the LED facade, so this is one of the billboards that actually has a wrap on a corner. So it's like a 2-story wrap. The lower panel, which is about 840 square foot of surface area, market rent for that's about $1,500 a square foot. The lower panel on 47th Street, which is about 2,200 square feet, is $1,000 per square foot. The upper panel, which is a really large sign, almost 10,500 square feet, $1,400 a square foot. So just between those 3 signs, you're looking at about $17 million a year in annual revenue. So really crazy when you look at the numbers. And so, Manus, I'm sure you have a little detail around this that we could jump into, but hopefully they can pull this one out. It doesn't look promising at this point.
There's been a couple of stories about ground leases in the past that we've seen that have run into issues. There was a property on Park Avenue, I think it was 399 Park, but I could be wrong, a couple of years ago, where the collateral had been an office building. The office building had been a ground lease payment that had to be made, but the ground lease payment was subject to a market adjustment over time. And the market adjustment was so big that it more than eliminated the rental revenue that was coming in from the office. And that led to a big default several years ago on the west side of Manhattan right now. The old Lullaby of Broadway Hotel, which is the Milford High Line, has been seized in that case as well. So these add a little wrinkle to what are, normally clean CMBS or CRE debt deals. It will be interesting to see what comes out of this. There is another big deal in CMBS. In fact, it's an enormous deal where the collateral is almost 100% signage revenue. And it's also in Times Square as well. And that's a loan that missed its balloon date sometime in the last year. And it's really hard to know how you value those things right now. right? 5 years ago, when Times Square was teeming, Broadway was always open. The city was full of people going to work 5 days a week. It was worth X. Now that tourism is down, we have all the impact from COVID, business travel is off, and people are coming into work 3 days a week. What is that worth? I don't think we've had any price discovery there, and it may be a while before we do.
Moving on to retail, in what was probably one of the most contested grocery mergers, the agreement between Kroger and Albertsons is hardly a done deal. Despite that, we took a look at it in detail to size up what the exposure could be with the new parent entity should that continue.
So on this story here, Martha, we actually have some content that we're going to be putting out that does a deep dive into this. So I won't steal the thunder here too much, but just to give our listeners a preview, we looked at the exposure across the CMBS universe, and we then mapped that across the different locations between each of the respective brands. So the Albertsons brand and the Kroger brand, because as part of this merger, there is some part of that deal that contemplates Albertsons spinning off some of their current assets into what they're calling a new company, SpinCo. So we wanted to see if there was a lot of overlap between the two entities, and surprisingly, there's not. California was the largest state that had overlap between the two different brands, but outside of California, it's actually a really complementary footprint across the two different companies. And so just to give some perspective here, there's 204 loans with an aggregate balance of $2.3 billion that have exposure to Kroger. There's 160 loans and $2.5 billion in outstanding balance that have exposure to Albertsons. So combined, the total exposure across the CMBS landscape that we're tracking is about $4.8 billion. So more to come on this with the content that we're putting out. It'll be interesting to see if the regulators allow this one to go through, because on a market share basis, both Kroger and Albertsons control a large portion of the grocery market. But from a logistics perspective of, these properties being complementary across the U.S. from a geographic perspective, it actually makes a lot of sense for these companies to merge.
And moving on, we had a story from a Nordstrom rack that is closing. And if you saw Nordstrom, they announced earnings, and it was a surprising disappointment with a quarterly loss.
Yeah, the Nordstrom we're talking about is at the IDS Center in Minneapolis. It's kind of the atrium, if you will, at the bottom of a downtown Minneapolis office building. It's one we've watched very carefully over the years. DSCR is not terrific. It's fine, but it's not overwhelmingly good. 1.18x in 2021, which was down from 1.59x in 2019. For H1 2022, DSCR was 1.15x. There is a top tenant there, which appears to be downsizing, law firm Lathrop GPM. They're not that big. They only have 7.6% of the space, about 100,000 square feet. Their lease ends in 2023, and we think that they're reducing square footage, but hopefully their spend stays about the same. So it is one of those loans that we're watching carefully, especially because it matures in the spring of next year. So losing Nordstrom's in that location, not a good sign at a time when the maturity is looming.
So you have a lot of other retail stories. Thematically, I'd say you've got some missing balloon dates, some values dropping, and some loan extensions, if I were to wrap them all up for you.
Some of these we put out as TreppWire trading alerts, and a few of them got a decent amount of traction on Twitter and feedback from our readers already. Run through them very quickly. Not a lot of good stories among these first couple, the value cuts. In fact, no good stories here. The Palisades Center Mall, which is in Rockland County, just over the Hudson River, the New York City suburb, its value was cut to well below the loan balance. The value of the collateral was originally $880 million back in 2016. It was lowered to $425 million in 2020, which was still slightly above the loan balance of about $420 million. This month, the value was slashed to $217 million. So only about 50% of the value of the outstanding balance of the loan at this point. The owners had negotiated an extension of the loan a couple of years ago, but this obviously is going to remain in the sights of CMBS investors for a long time especially now that the collateral is so underwater. The biggest piece of the loan backs a 2016 single asset deal, and there's also a small part which backs a conduit deal. In Ohio, the Dayton Mall, there, the collateral was cut by almost 70%. The property was valued at $132 million in 2012. This month, the value was lowered to just a little over $40 million. DSCR has been under 1.0x since 2019. The loan was scheduled to mature 2 months ago. Back in New York, the Eastview Mall and Commons loan, the value of the collateral there has been cut substantially. The property is in Victor, New York. Just another negative headline for CMBS investors. The collateral was valued at almost $370 million in 2012. That gave the loan an LTV of 57 at that time. This month, the value was lowered to only $101 million. That particular loan backs 2 CMBX 6 deals, and those two loan pieces are now substantially underwater.
Yeah, some of the takeaways from a couple of those, Manis, it looks like occupancy's hovered around 75% for most of those centers, and the square footage on these things are really significant. So on the Palisades Center, you're looking at 1 million square foot of retail space. So the lender doesn't want this property back. I mean, that's a behemoth of a property. On the Eastview Mall, that one was at 77% occupied. And it just shows at that level, they just can't make these things survive, but they've been hovering around that occupancy for some time. So it'll be interesting to see what happens here. We've done some research and put out some commentary around these mall loans. Most of them are 10-year full-term IO loans, and they've relied on ever increasing values, and upon refinance, just cashed out huge equity distributions and rolled larger and larger loans into these deals. And, 20 years of doing that finally catches up with you, and the market takes these assets a little bit out of favor. So we're starting to see that, these are another examples of just the malls really, really suffering.
A lot of criticism is given to special servicers, and the term is a denigrating one, the extend and pretend term that people use with these things. And sometimes extending and pretending is a bad strategy, right? Sometimes taking the loss immediately is your best strategy. But for some of these types of things, like these malls, to get rid of this thing in short order, you have to have a dance partner. You have to have somebody that wants to come in and either operate this mall as a mall at a lower basis, or they want to take the whole thing over and turn it into housing or something else, right? And the pool of those people is not enormous. So, I guess is my way of saying to those who are very critical of the special servicers, it's not always just a straight line between, what they choose to do and saying extend and pretend is a bad thing. There is some nuance to these things, and sometimes that's lost by people that are not, in the weeds every day.
Yeah, they would actually the servicers would be better off if these properties had 3% occupancy. When they're 77% occupied and they have longer term leases in place, even if somebody wants to buy it for redevelopment, I mean, that's a long drawn out process when you have that many tenants in there. So I agree with you. They kind of get a bad rap. And honestly, to get rid of some of these assets, you're talking about rock bottom basement pricing. I mean, we had a story on our Tuesday morning update call this morning where former United Healthcare building up in Wisconsin is going to hit the auction block on Cyber Monday. 46-acre building, former campus at $7 a square foot. So, buildings that have fallen out of favor for the market, when we say that, we mean there's really not a viable exchange marketplace where people will come in and pay anything close to market value or perceived market value when the loans were made.
Lonnie's going to make that a stocking stuffer for one of his boys, right?
Yeah, I joked earlier that we should start a fund and we could have some, your corporate retreats could be held at the vacant 46-acre building, and you could do some cool capture the flag or Nerf gun fights, that type of stuff.
There you go. Pivoting to a couple of the retail stories, these are not quite as negative. In a 2012 COM deal, this deal is backed by 2 malls, the Oaks Mall in Gainesville, Florida, and the West Roads Mall.
In Omaha.
In Omaha. There we go. Thank you, Martha.
You're welcome.
Both of those loans were extended for 24 months. So this is a modification that will impact the value of that COM 2012 LTRT deal. So for people that are trading that deal, something to watch. I always think an extension is a better outcome than extend and pretend. It means that the borrower is willing to probably fund some tenant improvement reserves or put more other types of equity into the deal. So that's a mixed green at worst, perhaps even a green shoot. Another one here, I'm going to mess up the pronunciation of this. The $211 million Clackamas Town Center loan has been extended. That is a 1 million square foot mall in Happy Valley, Oregon. For 2021, the loan posted a DSCR of 2.33x when occupancy was 95%. The loan matured in October. The new term pushes the maturity out to 2024. And I believe there are some extension options that can allow the maturity to go out another 2 years to 2026. So here, this is probably a mixed screen. On the positive side, the borrower is willing to stand behind the loan and wants to keep it going. I guess the negative side here is a loan with a 2.33x DSCR and 95% occupancy was unrefinanceable. And if you have numbers that are that good and you can't get refinancing, kind of a crabgrass type story for retail in general.
And how did I know that Westroads is in Omaha, you ask? Because I've shopped there.
Are you an Omahaan?
I'm an Omahan. Yes, I am. Omahan, which of course makes fun of the Iwegians.
Okay, there you go.
Like all bordering states do, right,
There
Lonnie?
you go.
I don't know anything about that. I'm from Texas, and we kind of just stick to Texas. So
Just
I'm
make fun of
learning
everybody
a bunch of really cool words. Just don't ask me to spell them today.
Well, we're going to ask you something later about Texas, Lonnie, so buckle up. We do have one more green shoot. I don't think we mentioned this last week, but it is a nice story. Kimco bought 8 retail assets on Long Island, grocery anchored assets across Nassau and Suffolk County on Long Island. They paid $376 million for those properties. That was reported by Newsday and also The Real Deal. So, in this market with higher cap rates than we saw a year ago, with high borrowing costs, any deal is a good deal, right? When you see somebody spending almost $400 million for a portfolio, that's a good transaction.
So let's move on to multifamily, where we've got a couple stories.
Yeah, and these are not great stories. They came in this month through our various data sources. We put out some trading alerts on them. And is this kind of a one-off, or is this the beginning of cracks in the multifamily? I guess time will tell. The first was in Queens, in New York. Queens is one of the 5 boroughs of New York. The $225 million Park Hill City loan went 30 days delinquent. The collateral there is a 538 unit apartment property in the Jamaica neighborhood. The loan was not on servicer watch list or with a special servicer and had never been previously delinquent prior to this month. However, DSCR was below 1.0x. This particular asset backs a 2021 multifamily deal. And I think this one is even more alarming. Out in San Francisco, the $340 million Veritas multifamily portfolio pool, and I should update that, it's more like a $450 million pool, is spread across 2 2021 deals. The servicer just revealed that the loan is facing imminent maturity default. The borrower has advised the servicer that it's not going to exercise its extension option, and the borrower will not pay off the loan at maturity. And Lonnie, you're going to probably have to get into the weeds on this and re-explain some of what we're talking about with these loan extensions and so forth, but I'll give the backstory here. The loan was slated to mature this month. The borrower had a 12-month extension option that could push the maturity date out to 2023. Chances are that was based upon some kind of criteria, whether it was a debt yield criteria or other things. Occupancy had fallen from 75% to 65% over the last year. And one of 2 things is happening here. Either the borrower is saying this because they don't want to pay for the cap that's required to buy down the interest rate to make the debt yield work, or they are truly not interested in owning this property anymore, and they're ready to give it back. And so I gave a little color about how this type of extension works. Lonnie, why don't you fill in the things that I didn't mention and give more color to that, because I'm sure I left out a couple of things there.
Yeah, I think it's, we've talked a lot about extensions. We've talked a lot about interest rate caps over the last couple of weeks. And so to actually see this one hit the market is very timely. A couple of initial thoughts on this. One, as you mentioned, Manus, with the debt yield on this property at sub 5 at 4.76, that's probably not meeting the loan covenant requirement in order to exercise the extension. Same thing with the occupancy. In most cases, in order to execute the extension or implement the extension from the borrower's perspective, the property has to be performing under the terms of the loan. So that could include occupancy, debt service, or debt yield. In this case, it's unlikely that it was meeting that criteria. The other thing that's interesting is it looks like there was only a 1-year extension. So I think if you look at this from a macro perspective, the property's at 65% occupancy, or the portfolio is. If you extend it 12 more months, how reasonably certain are you that you're going to get that to a stabilized operating occupancy? I don't think the answer is very advantageous for the borrower in that instance. So to your point, paying the interest rate cap, paying the extension fee, only buying yourself 12 additional months to try to get from 65% to say 90, it's a pretty tall order. So sometimes you just cut your losses, or as you've implied, potentially use this as leverage with the servicer. If they can negotiate a longer term extension, then maybe this becomes a little more viable, where they have time to execute, a repositioning of the asset. But with just one 12-month extension option, it makes this a little bit of a challenge. And so this was kind of a unique deal. This was a SASB deal. I think it was actually only an initial 5-year term. So it was kind of a short duration loan anyways. And then with the one extension option, when you see a property like this struggling, it doesn't give you a lot of time to actually remedy whatever is ailing the property.
Yeah, it's a very interesting story. A couple of other footnotes about this. Periodic host of this podcast, he comes on as a guest from time to time, Orest Manzi, pointed out to me today that this was once called the Lemby portfolio. People that have been in the CMBS market for a long time will recall that that was securitized back in, I think, 2004. And I'm not sure, 100% sure, but I think that particular pool took losses during the great financial crisis as well. He calls this portfolio kind of like B- C+, right? That it's kind of real low end quality. So that's one footnote on it. But the other footnote is, let's assume that this cap is 5% that they have to buy down the rate to make the numbers work. On a $300 million, $400 million loan, you're talking $25 million. That is a lot of money, to be sure, but there's an awful lot of equity in this thing too. It's a fraction of the equity. So if they're not willing to put up that 25 million and it's not a negotiating ploy, it means that the value of this thing has really, really sagged over the last 2 years, which may be true. We don't know, but we will find out in the next couple of months, and we'll stay on top of this story. And we're really interested to see how this plays out. Is this a negotiating move or is this something more?
All right, let's turn to hotels, and, let's have a little positive beginning to hotels, which is that Thanksgiving travel, according to the TSA, has already surpassed pre-pandemic levels. So that's a little bit of good news for us. And additionally, hotel revenues are expected to reach 2019 levels, according to the AHLA, which is the American Housing and Lodging Association. So all around, the lodging sector continues to get a bounce back after a very tough beginning to the pandemic.
Well, I got to give Lonnie a shout out today. He's joining us with flu symptoms today, which is going to put a crimp in his holiday and those that would have come to the Hendry household this week. So kudos to Lonnie for stepping up and keeping his Iron Man streak of podcasts going, even under the weather. So good for you, Lonnie. Bad for your family, and I'm sorry to hear that your holiday will be impacted.
Thanks, Manus. I'm probably more like the Tin Man, but I'll take Iron Man when I can get it. So we have a big 2014 hotel loan that was defeased. So Peter Grant of the Wall Street Journal about a year ago actually did some reporting on this and said that hedge fund operator John Paulson was actually looking at potentially selling the Coronado Vanderbilt Hotel and La Concha Renaissance San Juan Resort. That was something that caught our eye, and we noted that CMBS investors may want to footnote, as we say, the $111 million La Concha Hotel. that was split between two 2014 deals. This month, that loan was reported as defeased, and that's according to the servicer data that came in November. The asset was about 483 keys, full service hotel in San Juan, Puerto Rico, built in 1958. It looks like about $73 million of that loan comprises 10.13% of an MSBAM 2014 deal. There's a smaller $36 million piece that's part of another MSBAM deal, and was negative cash flow. Debt service coverage at the net cash flow was negative for 2020 before rebounding in 2021. And it looks like was actually really strong for the trailing 12 heading into March of 22 at 2.13x. And so the idea was that this hotel would actually sell into a strong market, making it a candidate for defeasance. And it looks like that's happened. A couple of those noteworthy comments from our team was that the defeasance has improved at adjusted subordination levels for the two CMBS deals. And the loan had an unusually long open period, which allowed for such defeasance. And so the loan matured in April of 24, would have matured in April of 24, could be prepaid freely 12 months before that. So, pretty good story here. And hopefully we'll see some more hotel news. I mean, Martha leading in with the TSA numbers, looks like maybe they've turned a corner there on the hotel sector.
A couple of other hotel stories that are also quite positive. In Chicago, I love this particular one. The Renaissance Chicago downtown hotel loan, a $70 million loan that was paid off this month. Why was that so noteworthy? DSCR was barely positive in 2020. A touch above 1.0x in 2021. The loan was scheduled to mature in early 2021, but could not be paid off. The borrowers negotiated an 18-month extension at that time. We've pointed out in the past that the Chicago hotel market has been messy, slow to rebound, and so forth. And yet this loan was able to be paid off. The collateral was a 553-key full-service hotel. DSCR for the trailing 12 months ending in June 2022, only 1.10x. So the fact that this thing paid off is a huge win for CMBS investors. It backed a 2014 deal, by the way. And lastly, this is a tip that came in from a listener. I won't mention his name, but I will say that he might be the biggest fan in the world of the hard rock band UFO. He's always urging me to listen to them, which I've done before. So I have to say I have put them on, but when I crank them real loud, my wife asks me to cut it out. So I can only do it when my wife is out of the house. But when I do, it's fun. Flynn Properties and Varde Partners entered into a $1.1 billion deal to purchase 89 select service and extended stay hotels. So as with retail, anytime I see a hotel deal coming out of the pandemic, even though that market has recovered very strongly, it's still nice to see a big hotel deal get done. It's a reminder of just how far the hotel market has come back over the last 2 years.
And we have a couple more stories that cover both student housing and the office sectors. We're really rounding it out today.
Oh my goodness, yes, it's a smorgasbord of stories heading into the biggest feast day of the year. So we'll go through that. I picked this one, the student housing loan, just really for Lonnie's sake, because he is a professor in Texas. He teaches at two different universities in that state. So this caught my eye. The student housing market has been very resilient since COVID, a big surprise by us. But this month, two loans that are near Texas A&M Kingsville have gone to special servicing. One is a $19.5 million loan. The other is a $13 million loan. They seem to be two phases of the same property. They back two different loans. One is in a 2016 CMBS deal. The other is a 2019 CMBS deal. But, I brought this one up just to have a little fun on Thanksgiving and maybe do something good. We'll make a nice donation, a $500 donation to a food bank, if Lonnie can tell us, as Mr. College Texas guy, what the mascot is for Texas A&M Kingsville. You got to know this, right? You're a Texas guy, you're a college guy. Come on, it's an easy one. It's a layup.
I think it's the Lions, but I'm not sure.
Oh, Lonnie, wah. It's the javelina.
Okay.
It's the only It's the only college in the U.S. with a mascot that's the javelina. It's Porky the javelina. And you probably knew this already. The javelina is in the peccary family. It's a medium-sized pig-like hoofed mammal in the family of the Tayasuidae. That's the genus. Let's give Lonnie one more chance so we can make a donation here. Let me think of something easier. Lonnie, how old are you now?
Just turned 41 in October.
All right, you got that one right. So we're going to make the food donation after all. So something for Thanksgiving, a reason to do something nice. Send something to the food bank down here in South Carolina in Lonnie's name, even though he didn't get the javelina right this time.
Well, I actually have a funny javelina story. My dad is a hunter, and in West Texas, people hunt javelina hogs. So when you say a medium-sized hog, these things can weigh a couple 100 pounds, and they have really sharp tusks, and they're very mean, and they tear up property. My dad may or may not have it mounted. My mom never let him hang it up in the house, but he may have it hanging somewhere in the garage with a wall mount. So I may snap a photo so Haley can post it on the web at some point.
Office.
Martha is without words for that last segment. All right, two quick office stories, one good, one bad. In Denver, Robinhood has put 120,000 square feet of office space out for sublease. That's from Kate Tracy of the Denver Business Journal. We've been keeping track of these things. We put out maps periodically of these big sublease spaces. Look for another one next month from us. A more positive story, I guess this is positive. It's, I guess, kind of mixed green. Texas Instruments is looking to lease space at Great America Commons in Santa Clara for a new office relocation. So obviously there'll be a loser in that space, which is their current existing headquarters, but the green shoot of it will be that campus at Great America Commons. The firm is looking for 210,000 square feet across two buildings at 4555 and 4655 Great American Parkway. So a little bit of good news to end today's Far Afield podcast.
A lot of stuff. Shoutouts. Alan A., Deborah at Black Eagle. I think I got a shirt coming to me. I'm very excited about that. Mark M. asked for the QDR and to sign up to receive some of our other research. We had some loan payoff requests after we talked about that last week. Philly Mike, Stephen R., Nick C. Kyle K. told Tommy C. that he's a big fan and has listened since the early days of the pandemic. Brad T. on LinkedIn liked our Tech Rec episode number 167. I think that was also the one where we talked about some of the REIT performance of the quarter. Zach F. on Twitter quoted our episode 169 and said, another great episode, definitely worth the time. And obviously in closing, want to give thanks to all of you for being listeners and having put up with us for the better part of 2 years. And of course, my pod team here, Manis, Lonnie, and Haley, you guys are smart, funny, and some of the nicest people I know that I've ever worked with.
Yes, Martha, I just want to underscore your point. We have a great audience. We have a great team here. I have so many things to be thankful for. And as the world turns and we see negative headlines from time to time out there, we still live in a great country here. There's so much to be thankful for. The enormous acts of kindness that come from people, our first responders, people who man food banks, healthcare workers, grocery store workers. They are in so much abundance more than the negative headlines we see. Don't ever forget that. We live in a great place and there's just so much to be thankful for. And everybody have a great Thanksgiving.
You don't want to follow Manis when he goes off on a soliloquy of thanks, because he kind of hit everything on the head there. But I'll just echo the sentiments. We have a great team here at Trepp. It's been really incredible getting to be part of this process, and the interaction with our listeners is probably the best part. So we've seen a huge uptick in people emailing, reaching out via LinkedIn, Twitter, et cetera, and it really resonates with us. So we appreciate everybody listening. Haley's kind of the unsung hero. What people may not realize is that she spends a couple of hours after each episode editing the podcast, making sure that we sound as close to great as we can. And so I just want to thank Haley for all the stuff that she does, because she doesn't get any airtime, although she should take some. But she really does all the legwork on the back end. And Martha keeps Manis and me on track. Without Martha, Manus and I probably would be on here for 6 hours a week, and then no one would know what we were talking about when we were all done. So incredible team, lucky to be a part of it. And I'm looking forward to us continuing to just bring content, research, and insight from the marketplace week after week.
And with that, we'll close. Thank you again to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment or a t-shirt, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well. Happy Thanksgiving, guys.
All right.